Okay, welcome back, everyone. We want to bring back our market all-stars. Joining us again, we have the whole team, plus Steve Grasso from the floor of the New York Stock Exchange. Steve, I don't know if you heard Keith earlier, but he's pretty bullish on things. He actually thinks we can gain 15% from current levels on the S&P right now this year, even with oil being where it is. Do you agree with that?
I wouldn't. I would tend to agree with it, because here's the other thing I'd like to ask him. Does he think that we'll have the volatility? We could be down to 1228 in the S&P and still finish off the year where he thinks. So I think that's the consensus, is even the bears.
Now, why are we going to grow that much? Is it because of inflation?
Well, no. When you look at these companies, these corporations are making money. Look at, as Larry said in the earlier segment, the ISM numbers, the retail sales numbers. We are back to pre-crisis levels on a lot of these different gauges in the economic conditions that we're in right now. I think we move higher.
Dan, what do you think about that?
Yeah, I was just going to mention, don't discount what's happening in the dollar. With the strong euro, you know, our multinational corporations are going to do really, really well. I think that has yet to be factored into the market. I agree. Longer term, as you know, I'm kind of concerned about what's happening. But for the rest of this year, I think you got to put a 10 or 15% upside on the S&P.
And you might see the rotation coming out of those best performers that we've seen year to date, those being the energy sector, the industrial sector. But you're going to see that rotation come back, and maybe it comes back into financials. No one's saying that the leaders of the past are going to be the leaders going forward.
Okay, but Al Nuckman, now this panel has turned utterly euphoric, all right? The panel
let's talk about volatility.
The panel is now all smoking the same thing. I don't want to name what they're smoking. All right, this is great fun, because we've had a lot of pessimism in recent days and weeks. But Al, let me just ask you, what if Ben Bernanke followed Jean-Claude Trichet and looked at the oil spike and looked at the food spike? The Fed's own beige book yesterday showed that prices are rising and they're being passed along at retail. What if Bernanke hints at a little rate hike sooner than everyone expects? What does that do to your outlook?
No, I don't think that's in the cards at all. If you look at the yields on the 10-year note, it's been declining after getting to some recent highs. So, you know, I think rates are actually coming down. That's not a concern right now. We can't afford to have that happen. But we're talking about these asset classes are all very bullish. You can lump gold, oil, and stocks all together. And who's going to step in front of those trends and fight it? As traders, you know, that'd be very risky. And there's been a lot of casualties.
Yeah, but no one's saying that those sectors, Larry, no one's saying that those sectors can't come in. Those sectors can come in. But that's what you get the new leaders in the marketplace, so that's where you get the rotation.
That's the volatility.
I'm just saying,
this is just the way they designed it.
You guys, you love growth, you love inflation, you love oil, you love food, you love everything. Somewhere in there, there's a glitch worthy of additional discussion.
I think
the bond market, is going to force Bernanke's hand.
Okay, you gotta go.
I'm not taking a position.
We appreciate it.
We're only at the halfway point in crude oil.
It starts to make you nervous, right? When they all start agreeing that they love everything.
I've said my piece.